Hi, everybody. Welcome to Screw the Stock Market, where we talk about alternative investments and with the goal of building wealth and attaining financial freedom. Today, we have a really interesting guest, Karl Yaacoub, and I love his general premise. His premise is he comes from the world of kind of institutional investments, right?
Yeah, he's an investment banker.
Investment banking, private equity, big money. And his premise is essentially, I'd like to take the lessons from these big companies, from the big money, and make them accessible to the average investor. And so it's cool. It's really a good call. He has just basic premises on how to add value to businesses. It's very much more in line with, the idea of buying businesses, of all the different things that we've talked about on the show. What'd you think of these?
It was good. It was good. I mean, and not only how to add value to businesses, but he also kind of broke down what you look for when you're purchasing a business and how to make sure that it's something worth investing in and purchasing. So kind of following the Warren Buffett value investing kind of approach to things. So it was good. I like that. It's one of those things that you and I have actually struggled with and did a couple of times where we try to figure out, okay, what is this business really worth? How do we establish whether it's worth the asking price when we're looking to purchase it? So he does a nice job of just kind of breaking down what you look at, what you evaluate, and what you kind of assess to make sure this is worth your money.
Absolutely. It's a good one. And I hope you get a lot from it and enjoy the show. Karl, welcome to Screw the Stock Market. We're so excited to have you with us today. Value creation, that's a broad term. We're really excited to learn more about it. Why don't you tell us a little bit about yourself and kind of where you came from? And then we'll dive into the essence of what we'll be talking about today.
Thank you, Alex, and thank you, Aziz. It's really an honor to be on your show. My name is Karl Yaacoub, and I'm a value creation specialist. My background is in investment banking and private equity. Right now, I'm running a Chicago-based consulting business called KYVC that is focused on helping privately held businesses in value creation. And so everything that private equity investors and sophisticated investors pursue in terms of value creation initiatives, my goal is to make this accessible to the average investor and to the average private business.
Awesome.
So that's awesome. Please go ahead, Aziz.
No, I was just going to say, can you tell us a little bit more about what you mean by value creation?
Yeah, that's a really good question. The thing with value creation is that it's a very generic term that a lot of people use. But the interesting thing about it is that it's highly subjective. So when you say value or how to create something that you would value, the first question that comes to mind is, what is it that you value today? So for you, Aziz, today, you might tell me that I value money, or I value time with family, or I value freedom, or I value being in a meaningful type of work with the people that I enjoy working with. The definition of value is highly subjective, but oftentimes it entails a combination of time, monetary benefit, and meaning. That's, I think, what everybody goes after. And every time I talk about this specific definition, a quote by Oprah Winfrey always comes to mind. And it goes like, you can have all that you want, just not at the same time. And so the message in this is that whatever we value today is going to lead to certain decisions that we make, to certain priorities. But these priorities might change with time. And when they change with time, so will our choices change. And we always have the freedom to choose.
Now,
there's some those are like fundamental things, right? And it's a good place to start because it's true. Like I always think about some conversations I've had recently with people who told me, hey, if I won the lottery tomorrow, I'd be 6 a.m. I'd still be there the next day at work because of the meaning, because of what it means to me. And it's something that different people value. A lot of people on this show, though, or at least the people that we're talking to are probably people who would not go back to work if they won the lottery. They'd say, okay, I might feel trapped with my job, or maybe whatever that is. And so, okay, so that's like kind of the big picture of value. Now let's talk about kind of within the context of your services and and your book, by the way, which again, we'll give you a chance to talk about your book too.
For sure. So the way I approach value creation is obviously related to my background in investment banking and private equity. And as you might know, that the angle that private equity investors have is acquiring businesses that are not necessarily operating at optimal efficiency, but have some potential in them that these active investors would then take a seat either in the driver's seat or the passenger's seat and help unlock that value along with the management team. And here's three things that a lot of these active investors usually go for in terms of value creation that many people do not realize. So it's a three-pronged approach that every private equity investor follows. That, by the way, any ordinary investor, so any person with an eye for investing who is looking to acquire a business and add value to it, could consider. It's really the same work. The only thing that is different is the number of zeros that you see on the financial statements. But essentially, the three key enablers for value creation, or the angles that these investors look to unlock, revolve around A, protecting the business, its assets, and its ecosystem. And the technical term to that is corporate governance. And the reason they care a lot about protection specifically is because when you protect the going concern of a business, its outlook gets better, which means more cash flows are going to be generated in the business with or without its current leadership. And that makes the business more valuable. The second enabler of value creation is corporate strategy. And we can break that down into organic corporate strategy. So leveraging a business's existing capabilities. So whatever capabilities it has at its disposal today, and inorganic strategy, which essentially entails leveraging yet to exist capabilities, or acquiring or merging with or JVing with other businesses. And both of these fields are highly relevant for value creation. And the third enabler of value creation that I want to touch upon today is strategic finance. And this is all about knowing where to allocate your resources and in which channels to allocate them, so that A, you maximize impact achieved that would be in line with your strategic aims, and B, you would minimize opportunity costs in the process. Because what you don't want is to allocate your assets and your resources into initiatives that are going to lock your cash instead of putting it in the right channels that are going to yield the highest benefit. And so corporate governance, corporate strategy, and strategic finance are the three key enablers from a technical perspective of value creation that active investors usually follow. And this is not just active investors, it's the most valuable companies in the world, publicly listed companies, they all follow that same approach. And so whenever they hire the big management consulting firms, whenever they hire the investment banks and they put on the advisors, the legal advisors, the accounting advisors, the technical advisors, oftentimes it's something within these three value creation enablers that they're looking to unlock.
Can you give like an example of someone analyzing all three of those for like something that you've worked in the past, or maybe something you've dealt with or read about or whatnot? Just because these ideas still seem abstract for the normal person who probably has never worked with them before. So something kind of like more substantive that they can show a direct example of each of those would be great.
Yeah, for sure. So let's say there's a private business that you are excited about acquiring today. Right. You set up a principal to principal meeting and you go meet with the seller of the business or the owner of the business. And in your discussion with the business, you realize that the dollar stops at the owner's level. So the buck stops at his level. In other words, there's a key man risk dependency on that person, which means that if that person were to leave, there is no clear authority matrix over who makes the decisions and what authority limits exist for each of the management team members. And so this is a problem, because if you are an incoming investor and that person is cashing out and leaving the business, what you want to do is make sure that the business no longer relies on one person or on a key set of individuals. What you want to make sure is that you have the right organization structure with the right authority matrices and the right reporting lines so that decisions are made and work flows in the organization regardless of who is the individual in that seat. So that's one way corporate governance is important, because it limits that key person risk dependency. And usually when there is that kind of dependency, it's often a red flag, because a departing star player or a departing star founder, in other words, that would be the baby that they're leaving behind, that baby is not going to be in good hands, in anybody's hands, really, because nobody is going to be that passionate and that caring for their business as much as the person who created that business in the first place. And so to reduce the impact of such a risk, you want to protect a business's assets and its ecosystem. And this is where corporate governance comes to play. Now, moving on to strategy. If we want to talk about organic strategy, or in other words, leveraging a business's existing capabilities, what you want to look at are things like whether or not a business has a pricing strategy. If a business is competing in a certain market segment where the typical customer is valuing customer service or the customer journey, or even after service, or maybe status and prestige over and above just pricing, then you cannot approach your pricing strategy in such a way that you want to compete only on price. What you want to do
This is like a luxury good, for example.
For example, yeah, what you want to focus on is on perceived value. So you want to take on initiatives that would ideally enhance how the market perceives your product and your brand positioning in order to be okay if you command higher prices. Another way is to look at your product strategy. Are you selling a highly generic product, or are you selling a product that you are looking to innovate year after year? And even if your competitors are not innovating, that does not mean you shouldn't. And the key idea in product strategy is to look at yourself as your biggest competitor and to always think about how you can make your product better depending on what your ideal customer values in your product.
I'm going to ask you to say that one again. I think that one was a really nice Instagram kind of clip. The idea of competing against yourself. Do you mind repeating that one?
Yeah. So the one key element of having a sensible product strategy is, regardless of whether or not your competitors or new competitors are competing with you on product innovation, you should treat yourself as your biggest competitor. And you should always seek ways to enhance the quality of your product and B, the experience that your customer is getting from purchasing your product. What you want to do is continuously innovate and continuously delight your ideal customer, because this is one of the strategies that would inevitably help you with your pricing continuously, because you're doing such a good job. People are happy to pay a higher price, and it's going to trickle down to your bottom line. And so this is going to help you with value creation and with enhancing the valuation of your business. Another area we can focus on within organic strategy, for example, is sales and marketing. And oftentimes people confuse those two. And it's very simple to confuse them because they are the same side of the same coin. And so while marketing is all about generating interest in who you are and what you have to offer, sales is about monetizing that interest and converting it into an actual sale. And so this is all stuff that fall under organic strategy. And obviously there's a big list of initiatives that fall here, but to give you an example, this is potentially what we could do. So if we were to move to inorganic strategy, let's say you are a construction business and within construction, you do false ceiling services. So you enter into residential and commercial buildings and you help them design and implement false ceilings so that the interior design of that space is more aesthetically appealing. And so in order to enhance your offering, you want to add a supplementary service to that. And you think that having a flooring business in addition to the false ceiling business might make a lot of sense, because a lot of your clients have been asking whether or not this is something you provide. But you don't have the know-how for this specific segment in the market. You don't have the operational know-how. You don't have the technical know-how. You don't have the supplier relationships. You don't have the inventory for it. So one quick way to go about that is to consider either acquiring or merging with another business. And what essentially this gives you is a fast ticket into that desired outcome that enables you to leverage yet to exist capabilities. In other words, capabilities you do not necessarily have today, and hence the term inorganic. Now, moving on to strategic finance and all about asset allocation and diving deep. This is essentially dissecting a business. Yeah.
This is the third prong.
This is this third prong, exactly. This is essentially dissecting a business from a financial standpoint into hundreds of small pieces and trying to figure out where could there be opportunities for trapped cash that you can unlock. And so what you want to look at is not just the P&L statement or the income statement of the business, because an interesting thing about business that a lot of people take for granted is you can own and operate a business that is loss-making, provided it still has cash reserves. But the second the business runs out of cash, it's over. So it's not a question necessarily of profitability. It always is a question of cash, because cash dictates how much time you have to operate.
So it's like the overall cash flow of the business.
Yeah, so it's all about cash inflows and cash outflows and how everything feeds into the cash flow statement. So if you were to look at the income statement, you want to understand how the income statement is linked to the cash flow statement through operating profit or through net income. And then you want to look at how changes in the balance sheet, and that's changes. So how your assets are increasing and how your liabilities are increasing or decreasing over time, how this affects the ending cash position for every period in your cash flow statement. And then from there, you are able to figure out where are the leakages? Where could be areas that we could work to stop these leakages? What could we do to prevent certain things from happening? For example, you could be booking revenues for sales that you're making, but based on your sales terms, payment is in 60 days or in 30 days. And so you put this as an account receivable on your financials. But unless you collect that account receivable, that revenue or that sales figure that you booked doesn't mean anything, because the cash for it is not in your bank account yet. And so if you have an aging receivable schedule, for example, if you have a lot of revenues that you booked that you are yet to collect the accounts receivable for, and they've been outstanding for a while, there could be a problem in your cash flows. And so you have to fix that.
So it's interesting. It seems like with this three-pronged strategy, you can not only evaluate the value of a business, but you can also find ways to improve your current business. So you can use it like either way, really.
Absolutely. Yeah, you could.
Interesting. You mentioned something that made me think of, like when you read in the news these headlines about these big billion-dollar companies that have never made a profit. I was always confused by that. Like, I think Snapchat or like some of these companies that just like were losing money. I was like, but they don't even make money. How can you lose money that you don't even have? And I think it's getting into that point. Maybe that's just like venture capital and just investors, and they're just blowing through investor money. Is that what's happening there?
That's exactly what it is. It's blowing through investor money. It's raising more equity, bringing more cash into the business, regardless of whether the business itself is generating a profit or not. And usually the reason these investors are throwing these ridiculous amounts of cash is because they are buying into the equity story of that business. They're not buying the business for what it's doing today. They are buying the dream, as a lot of investors like to label it. They're buying the dream, and oftentimes it's a gamble. But that cash that they're putting in is what is keeping these businesses on their feet, and not the profitability of these businesses.
So it's interesting. You talk about the dream of the business. How do you know when, in terms of like something like, say, like a business like Snapchat or one of these, money pits that are still doing well because people keep dumping money into them because they vision it to be successful in the future? How do you know when you're valuing a business, whether that's something worthwhile to just kind of hunker down and ride it out, or it's something that's just going to end up losing your shirt on in the long run if you
Absolutely.
try to invest in it.
Yeah. So as you know, obviously the way you value a mature business is by looking at cash flows and then taking a discount rate and coming to the present value of a business based on its current operations and the projected cash flows. But with a disruptive business like the one you just alluded to, it's a different equation altogether. You are looking at the story, the equity story. What is the team trying to do here? This is what you care about the most. You also care about whether or not there is a disruption in the business model. So what would be, if successful, the impact of such a business on the industry, on the ecosystem? Is the market ready for such an innovation? Is the market likely to embrace such an innovation? And that's obviously a call that you have to make. It could be yes, it could be no. And you can't tell initially. That's why the returns that you'd expect are significantly higher. More importantly, you want to bet on the team itself. Is the team capable? Do they have a good track record? Have they done it before? Have they had successes in previous ventures? And that should give you some kind of assurance, because as we talk about value creation, when you follow a methodical framework for creating value, regardless of where your starting point is, the likelihood of success is much higher. You know what you're doing. You are, in a way, you know what the end goal is, and you are reverse engineering from that end goal into the present. And you have all the milestones identified, and you have all the steps you need to take identified. Now, obviously, you might have to pivot, but you know where you're going, or at least you know where you want to go. And that makes all the difference. And that gives the investors the confidence to justify a gamble, really, because it is a gamble of this nature.
Now, I'd like to we've covered the three prongs now, and I hate to cut you off, but I think I want to target our conversation a little bit more towards smaller kind of ventures and, us as individuals who are going to buy a business with the intent of adding value. So if we could maybe, some of these examples, like the first prong, the corporate governance, right?
Yeah.
Like I was looking at a business that was a flooring company. You used that as an example.
Yeah.
And it was two guys who had been running it for 30 years. Yeah. And they had 0 employees. Yeah. And so at the end, that was the main reason I decided to not purchase it, was because I was buying a job, right? It was going to be me and only me in this new company.
That's exactly what it is. Yeah.
Now, with a bigger company, with a bigger budget, obviously you probably will already have some staff. What are some of the ways that these three prongs manifest when you're talking about smaller ventures and smaller, smaller dollar amounts?
Yeah. So governance becomes not about really having these very fancy organization structures and the board and all that stuff. It really becomes about having the right approach and having the right controls in place and having the right discipline. And what I mean by that is very simple stuff, such as, not putting personal expenses on the business credit card. It's about separating the two. And you'd be a little bit surprised about how oftentimes these things overlap, especially with businesses like the ones you just talked about.
Yeah, you look through their sheets and it's a mess. Like I'm like,
yeah,
how much money do you really make? I don't know.
Exactly. You want to clean out the business. You want to know what is going where, and what is the decision-making framework behind that. And governance is really about two key things: the way decisions are made and the way work flows in a business. And so really, regardless of how big the underlying business is, if you have a systematic way to manage A, the way work flows in a business, and B, the way decisions are made in a business, then guess what's going to happen as you grow and as you scale? It's going to be much easier. But if you don't, you're going to have bottlenecks, you're going to have tension, you're going to have confusion, you're going to have a much harder time on the way.
If you were to say be in the position now where you would be purchasing an example like that small flooring business that Alex just mentioned, what would be the steps that you would go through? What would you do first to decide, should I buy this business or not?
Sure. So it would be the same steps that you take in any purchase or any acquisition. Let's say you want to buy a car today and it's a used car, it's a secondhand car because of where the prices are today and how everything is going up in pricing. And so what would you want to do? First, you want to go talk to the person selling the car and ask a few questions. And then what's the next question that's going to come up? Can I try it? Can I test drive it? Right? So you want to do your due diligence on that car. And they might tell you what the asking price is initially. Let's say they tell you it's $20,000, but when you take that car for a test drive and you realize that it is making noises or something does not feel right, you're going to be like, hold on a minute, that car is not worth $20,000 because there's quite some issues with it that need fixing.
So how are you taking a business for a test drive?
You do your due diligence. That's exactly what you do. So what you want to do is look at a variety of different things in the business. And it's the same scope of work that every buyer looks at, regardless of how big the business is. You want to look at the accounting side. You want to make sure that the financials are clean, that there's nothing shady going on, that the business is generating a certain level of recurring revenue. And recurring is a key word here, that it's not just a one-time thing, that it is not exposed to just one or two big clients. And if these clients go away for any reason, then there's no business left. You want to look at your accounting. You want to look at your legal stuff. You want to make sure that the business is not in current litigation with anybody. Because what you don't want is to come in and realize that you're being faced with lawsuits and that the business is not what you thought it was, or that the former owner was in trouble legally and sold that business for that reason specifically. And now you have to deal with all this headache. What you want to do diligence on is the commercial aspect. So you want to look at the market and where it is heading. And when you talk about market, you want to look at four key things. You want to look at demand. How big is the demand today in the market? You want to look at supply. Who are the key competitors and how is that supply likely to change? You want to look at regulation, because that's a big one. Is there new regulation that is upcoming that is going to create some headaches for operators? Is the barrier to entry low for such a business? Is it hard to get into that kind of business? What are the licensing requirements? All that stuff. And the last thing is manpower. How easy it is for you to find talent. How easy it is for you to recruit people. What is the current landscape like? Do you need to recruit internationally? Do you need to procure visas? Are you going to have problems with the wages you're paying? Are you going to need to double your wages in order to attract the right talent? And what would the implication of that be on your bottom line?
That seems like a key one recently, right? The idea of manpower seems, you see all these headlines about how, and you feel it. Like, I mean, I've taken a few flights over the last few months and the airline industry is hurting, right? They don't have enough pilots. They don't have enough stewardess, the air traffic controllers. Yeah. So that's a really interesting one for just this day and age, right? Like, I think a lot of industries are hurting for manpower. I like that. I like that framework of looking at a business. So that's, how does it work at a smaller scale, right? So like, again, going back to that flooring company example or a laundry example, Aziz, keyword, we need to make that call. We got a lead on a laundry. So I'm pumped up about that one. So there, I guess demand is just much more localized, right? Maybe you look at...
You want to look at the catchment area. When it's a localized demand, you want to look at how big is the catchment area that you're looking to serve. You want to look at the number of laundromats in that catchment area, whether some of them are going to close, whether new ones are coming into the picture. And you want to do some benchmarking too. So you want to see how the supply compares to what you are trying to offer. It's not just a laundry business. It's the same with even a school. It's the same with a hospital even. You want to look at the catchment area that you are trying to serve. And then you want to see how is that catchment area likely to evolve in the future, because that could either be an opportunity for you or it could spell bad news for you. And it's something you do not have control over.
Very interesting. So, okay, so now I'm thinking about who our listeners are and who would take this and run with it, right? So we've had episodes that are on real estate and value add. I think, especially when you look at business, you look at real estate as a business, all these things can apply. We've had people who come and listen to episodes about buying a business, which is probably the most easily transferable one. What are some things that you think everyone should know, even if they're not necessarily looking to acquire businesses? What about passive investors or just other people who are just generally focused on building wealth?
I think for me, I always am skeptical about the term passive investing because I see it being used a lot these days by a lot of people of all ages as if that is the end goal, to be a passive investor. And I see it unfortunately used a lot in the real estate space. But I don't think that people realize that even with real estate, it never is 100% a passive investment vehicle because there is always some kind of maintenance work. There are always headaches that you need to worry about. I mean, I've done deals in real estate in the past. I've done it at the institutional level also, and 100 million plus deal. And what that was a sale and lease back. And there's always things you need to worry about. You need to worry about insurance. You need to worry about, depending on the actual lease that is signed, there might be responsibilities on you as a landlord that you need to honor. Right? Let's talk small scale because that might be more relevant. Let's say if the boiler breaks down, who's going to fix it? It's not going to be the tenant who has nothing to do with it. It just broke down. You haven't changed it as an owner in a while. And so you're going to have to worry about that. And let's say you're not in the country or you're in a different state. You're going to have to compensate the tenant for it.
Mm-hmm.
Right? If you are right now on a variable, a lot of people like to use the leverage structure in real estate. They want to put that 5% down payment down if they could and take that FHA loan or put the insurance policy on it and pay the 95% over time from the rental income that they produce from the tenants that are in the asset in the unit. And what do you do when it's a increasing interest rate environment like it is today and your rent is not enough to cover that mortgage payment? What do you do then? You have to fret, especially if you have 5, 6, 7, 8 units.
Mm-hmm.
And the second you imagine one of these units, you lose a tenant, what's going to happen then? Then you have twice the headache and you're freaking out because you don't want to lose your asset that you've been paying for 4 years, say, from your strategy. And honestly, I don't think it's really passive. I mean, even what is the most passive type of investment that you can think of? Buying a stock on an exchange on your app, on your phone, right? And then forgetting about it. You're still going to check that app every single day if it's a good position. If you're buying crypto, you're going to check it every day. You're going to have to go through headaches to set up your account, set up your password, do all that stuff. And then when you want to take your money out, you're going to go through the same headaches. And my point is, it will always entail some kind of energy from you. And the reason is simple. The second you commit money or resources and energy into anything, you have what we call skin in the game. And the second you have skin in the game into any investment, you suddenly tune into this mental and emotional frequency that is very different from being on the fence and being an outsider. You suddenly are consumed by whatever it is you are invested in. You have some kind of ownership. You care more. And for a lot of us, and I know it sounds a little silly, we get attached to our investments. Even if they're just numbers on a phone or just letters on a phone, we get attached to them and it becomes very hard for us to let go or even sell, even if it's at a profit. And so passive investing for me is, again, like we spoke about value creation initially at the beginning of our conversation, it's a very subjective term and one that I look at with a little bit of skepticism, if I'm perfectly honest with you.
Okay. I mean, for example, as a private equity person, what about the investors in the private equity, right? You invest in an offering, a private offering. Is that passive in your opinion?
Not at all. Are you kidding? You're next on the line. Because think about it. You're going to want to make an investment. You're going to have to go to the investment committee and you're going to have to go to the board of directors and pitch that same deal that you were pitched. So let's say Goldman knocks on your door and presents that opportunity for you to invest in this business and you run your numbers and you like it and you think it matches your investment criteria. Guess what you're going to do? You're going to run your numbers. You're going to run your returns. You're going to run your investment thesis and lay down a hypothesis as to why this really makes sense for the fund. And you're going to go pitch it to the investment committee. What you're going to ask for is the green light, the go ahead, And B, you're going to ask for money to do the due diligence that we spoke about earlier. You want to hire the McKinseys, you want to hire the big law firms, you want to hire the accounting firms to do all these work streams of due diligence so that you vet that business and make sure that what you end up paying for it is not something out of whack, and that your investment thesis that drove your decision to make that deal in the first place holds after you complete your due diligence exercise. And so let's say that goes through, and then you have a 5-year business plan and you have the budget for the first year. Let's say in the first year you didn't meet your budget. What's going to happen to that 5-year business plan? If in the first year you don't meet your numbers, you're never going to meet them in the next 5 years. It becomes ridiculously difficult. Let's say the business today is generating an operating profit or an EBIT. Let's keep it simple. Let's say it's generating a net income of $10 million. Okay, or let's say it's generating a net income of $1 million to keep it small. And in your 5-year business plan, you're saying the business is going to get to $4 million in year 5. And in year 1 year from today, it's going to make $1.8 million in net profit. If that year passes and the business makes $800,000 in net profit instead of 1.8 million, do you think you're going to be likely to meet that net income figure that you projected for year 5 of 4 or 5 million? Impossible. Very difficult. And so what are you going to have to do in that case? You're going to have to go back to that investment committee or board and explain to them why that business did not generate the results you thought it would. And it's your neck on the line, because you are the one who fought for it and you are the one who made the case for it. And when you buy a business of this nature, you generally want to have some kind of control. Here's something that I think is relevant to your audience. There is a good reason you want to say screw you to the stock market, and that is control and autonomy. When you invest in a public security, you are just sitting as if you're sitting in a movie, and you're just waiting for information to be disclosed to you. And you don't have a say at all in really what goes into product innovation. Like, I have shares in Apple, right? Do you think I had a say in what the iPhone 14 had in innovation or in specs? Or do you think they listened to me if I had told them, oh, I don't think that's so much different from iPhone 13? None. They do disclose with me information as an investor, right? As with all investors. But I do not have any control and autonomy or say in how the business is being run at all. When you look at private opportunities, the game changes. You become in the driver's seat, or if not in the driver's seat, you are in the passenger's seat, and you can tell the driver, hey, I think we should leave at this exit. And they're probably going to listen to you because you are a shareholder. And that is a very different way of looking at investing or active investing. It opens up a whole lot of opportunities that, quite frankly, if executed in the right way, could yield returns that are far superior to the returns you could expect from, say, the S&P 500 or other publicly listed companies.
Very exciting. Well, Karl, I want to give you a chance to tell us a little bit more about your book and other ways that maybe folks in our audience could continue to engage with your very interesting content. You know, I'll say that the thing that I love most about everything you've shared is just the premise that you're trying to take the ideas and the strategies and the knowledge that exist for the private equity, for the big business, and make that accessible to the average investor. That's super exciting, and I'm 100% behind you on that. I've always had that feeling that there's information out there and we all need access to it. And so thank you for doing what you do. Please tell us a little bit more.
Yeah, no, I appreciate that, Alex. Thank you. It's exactly what you just said. It is the inspiration behind it. It's called The Game of Value Creation. And initially, it sounds like a very subjective, generic term, but the subtitle for it is Think, Make Decision, and Create Value Like an Active Shareholder. And the whole premise of the book is using the same tactics and insights, more importantly, that all these big investment banks advise their blue chip clients on as to where could be value that could be unlocked from deals that they would make. And so the way a lot of these active investors approach value creation, as soon as they make an acquisition, they often implement something called the 100-day plan. And in that 100-day plan, there is a clear layout of all the initiatives they want to take to set the business on the right path so that they can create value, or in other words, enhance its valuation. That really is the premise for a lot of these active investors, enhancing the valuation of the businesses they acquire, because the only way they make returns as a financial investor is A, through dividends from these portfolio companies and from selling these companies. And they want to sell it at a significantly higher valuation than what they got it at. And so that 100-day plan revolves around these three value creation enablers that we discussed. There would be a wide range of initiatives under governance. There would be a wide range of initiatives under strategy, and a wide range of initiatives under finance. And there would even be a wide range of initiatives under leadership, and what are the things that they need to make sure happen in the business so that they have a scalable leadership framework. What they want to do is they want to cultivate a culture of leadership so that the people who are there today can pass the torch to those who come into leadership positions tomorrow. And these people who come in tomorrow take the leadership in the business to a different level. And so it just highlights, A, what are these initiatives? What do they look like? What do they benefit the business? What do they do for the business? Because I want the readers to really consider the why behind these initiatives and not just do them because, oh, okay, this is a manual that, okay, this is how they do it. That's what no, every business is different. Every business has different capabilities, has different limitations, and has different willingness and ability to take on risk, because change as a process is very uncomfortable for everyone. And the implementation of any kind of initiative that entails change is a very iterative process. When you go about implementing change, you're going to have a lot of resistance, you're going to have a lot of tension, there's going to be a lot of uncertainty, and there's going to be a lot of back and forth with everyone in the organization. And you want to make sure that you are taking into account all these different elements. And so the book really outlines that from a both theoretical standpoint. So I assume a very basic level of knowledge from the reader around, numbers, and they need to be able to talk business. They need to be able to talk strategy. But more importantly, it also carries a lot of insights and action steps that the reader could consider. And the goal is not to just consider these action steps blindly. The goal is for them to give them some thought and think about, why would this be relevant to them? It might not be, but it's the key idea is to agitate the reader into the right frequency and help them tune into that frequency and think about value creation in a little more sophisticated way than they would give thought to. And that's not because I wrote it. It's because that is the framework that is tried and tested and adopted and followed by all these big guys. And I think it could do a lot of good to the average investor.
Very exciting. Well, where can people find the book?
It's out in October, and they could either find it on Amazon or Barnes & Noble.
Beautiful.
Awesome.
Very exciting. Karl, thank you so much for being with us. Do you have any last words to share?
Yeah, I would want to share the following insights with whoever is listening and whoever is trying to create some kind of value in their life, or whoever has an eye for investing but for some reason is struggling or is making mistakes or is finding it ridiculously hard. And I just want to tell them that it's part of the process and it's part of the journey. And one key thing to keep in mind, as much as I hate to bring this point, and as much as any listener would hate to admit, that whenever you approach investing, the only way you can become a better investor is by making mistakes. And making mistakes entails losing money. And I know you might tell me Warren Buffett says, the biggest mistake you can make is lose money, and rule 2 is never forget rule 1, and all these things. But when you lose money and when you hit your head, you will grieve. It's going to hurt you, because especially if it's money you worked so hard to earn and to save. It's going to hurt you and you're going to grieve. And it's a process like with any kind of loss. And it's not fatal. That's the good thing. That's the silver lining in this, is that loss is not fatal. And the blessing in disguise with loss is that you level up in the process. And there are other ways to level up, but for me, I found this way to be the most effective because it hurts the most. And when you level up after grieving and losing money, the way you start approaching things changes and your behavior changes. Think about how hard it is to change your behavior today. I mean, if you just look at your behavior as a series of data points, you're going to realize, and that's an awkward realization, but I think for the majority of us, they are very similar in nature. Every day you follow the same routine, you have the same kind of structure and the same kind of discipline. And a part of it is conscious and a part of it is unconscious. It's very hard to change human behavior. One of the best ways to make a breakthrough in that is struggle and loss and grief, and take it from someone who's been through it before and is still going through it and goes through it a lot. It's part of the journey. And you never invest wanting to learn a lesson. You invest because of what the investment entails in terms of upside and excitement. And that's why you get into business the first place. You never get into business because you want to hit your head and fail and hurt and grieve and lose money and look like a total idiot in front of everybody you care about. That's not why you do it. When that happens, there's a lot of growth and a lot of evolution that comes out of it. And I think that's something that could help a lot of people in the investing space.
Thank you so much. That is very true. I mean, we felt it as well.
Oh, you did.
Many ups and downs, but you learn so much along the way, definitely, and you come out better for it. But yes, I fully agree.
Thank you so much. Well, we'll call it a wrap then. Thank you so much, Karl.
You're most welcome, guys. I really enjoyed this chat. Thank you very much.